For more on why the gold continues to remain range-bound, I want to welcome to the show David Fischer. He's the founder and CEO of Landmark Capital. David, welcome to Futures with Lichtenstein Hincks. Great to have you back. David, last week I was wondering why the gold was limited relative to the geopolitical concerns. Now I'm starting to wonder, why is gold so limited as we're seeing rates on the move into the new 2018 highs? What are your thoughts on this?
Well, you're absolutely right. We've seen gold stuck in a pattern between 1310 and 1356. It's been in that pattern for about, it's hit the top of the pattern 9 times in 2.5 years. It hit the bottom of the pattern 6 times this year alone. There's a lot of dashed hopes in the gold market on the retail side, thinking that this was going to bust loose because of what's happening with the tariff wars, what's happening with higher rates, debt structures of the world. And clearly we have enough information out there that says gold should be moving high, but it's not, because there's no crisis happening right now. I think when we moved above 3% of the 10-year yield, that did cause gold to bump up a little bit yesterday. I think that's the fundamental side, the technical side. And I know that Kevin was talking about this earlier in the previous segment at 3.05%. That's the big resistance level. I think we're going to break through that. I think that will help add higher prices in gold. And of course, the Fed, when they raise rates, that will probably add some higher prices. There's a 90% chance that we're going to have a rate hike in June, a 64% rate hike in September, and about a 32% so far rate hike in December, although that's more off the table. These should cause a little bit of bumping up in gold, but I don't think we're going to have a huge breakout in gold. In the 25 years I've been doing this, I don't see that environment right now. So to make money in gold, this is not a play you're going to make in the short term, I don't think, unless you're a really very good trader happening in the gold market. But there are some fundamentals like the debt structure of the world that are going to come into play. Global debt is going to weigh on equities, I believe, next year. In fact, there was a poll that was put out by JP Morgan recently that polled 700 ultra wealthy investors, people who have $30 million or more liquid cash. And the poll said that we're going to be 70% of these investors said we are going to have a recession next year or in 2020. 50% were saying 2020, and 19% were saying 20% were saying at the year 2019. So those are things that are going to weigh on our structure and cause higher prices in gold. And gold has been tied to the debt. There's been a direct correlation to higher debt levels. And looking at the global debt at $257 trillion now, we've risen 21 trillion just in the last year and 50 trillion in the last decade. So that means the debt is escalating. I think when we move into higher interest rates as the Fed raises them, that's going to cause some uncertainty. But there's not enough uncertainty right now, Ben, to cause gold to break out above the 1356 level.
Hey, David, I saw your name in a fairly interesting article where you talked about your like of the TD Ameritrade IMX, the Investor Movement Index, and how you use it yourself. Now, for people that don't know, it shows how investors move in and out of stocks, and it names names. How do you use the TD Ameritrade IMX? Because we have a new one coming up here in just over a week.
I'm anxious to see that, Kevin. As the IMX index is not based upon emotion. It's not based upon what we think is going to happen. It's actually based, as we all know, based upon what has actually been done and the sentimental actions and how long we are trading within certain products and components in the markets. So it's not based upon what the commercial banks are doing or the commercial industry or what the computers are doing, which is really what's driving the volatility, in my opinion, of this market. That index is down 39% and started in January this year, which says the investor should be engaged in this market. There's huge opportunities. Anytime we have these market swings, we should be using this index as a gauge to say, where should I be investing in? Not where should I be sitting on the sidelines. So I'm looking forward to that tool coming up, Kevin.
David, let's talk a little bit about the dollar and its ties to gold. We usually see that inverse correlation. I'm curious if you think that this is, with the dollar recently back to this 91 area and potentially into, again, recent highs here, I'm curious if you think that's the reason we're seeing some of the weakness in gold.
Yeah, I think you're exactly right, Ben. I think the dollar's going to maybe move up into the 92, maybe even 93 area.
Okay.
President Trump wants a strong dollar policy. Yet he wants lower oil prices, and oil is gauged in dollars mostly, except for what this Petro one that just got recently launched on March 26. But besides that, there is a direct, pretty strong correlation still intact between higher dollar index and lower gold prices, spot gold. And I think we're seeing that in place. I don't see that being decoupled. I think that's going to get more solidified. And I think we're going to have a little bit of pullback in gold. I don't think it's going to drop below the 1310 level. I think that's a very good, strong floor position for gold. I certainly don't see the dollar collapsing like some people talk about in my industry. I see the dollar over time this next year moving lower, but in the short term, I see higher dollar index and lower gold prices for the most part.
David, as you know, we get to do informal polls here as we do this show, and there were so many dollar bears in the last few months that have all now started to creep in to the bullish side. But you're the first one, I have to admit, that's gone to a 93 level in the U.S. dollar, and as we know, that's going to take its toll on commodities across the board, right? Not only gold, but it could be oil, it could be grains, it could be everything in terms of a dollar-based commodity. What do you see as terms of the dollar's effect on commodities across the board?
Well, I think there is a direct correlation. We're in a unique environment right now, Kevin. We're in a cross wind happening in so many directions. Will the Fed continue to raise rates as the yields go up, or will they become market sensitive? Currently, Jerome Powell, is data driven, and that's what I like about him versus Yellen and Bernanke. So I think, we're going to see higher prices. It will affect a lot of different commodities. We saw a breather here of higher commodity prices recently, just for a short term, and oil moving up. I think, it's going to pull back for a little bit. I don't think we're going to have aggressive pullbacks, but I wouldn't be surprised if we did see a $93. I think we're going to be resting in the 92 range for some time. But I think when we get towards the end of the third or fourth quarter, I think you're going to see some changes happening in the gold market and the dollar index. I think we're going to see a reversal from where the short term is right now. So, we're in a very unique environment that I have not seen in quite some time, where this environment changes rapidly. And it's based upon sometimes tweets that are done by our president, sometimes things that are said by the Secretary of Treasury. We have a few wild cards out there. Tariffs, obviously, they're looming. Will that get rectified? What will happen with North Korea? If those things turn sour, we could see some higher prices in gold and some lower dollar index numbers. But right now, I think you're going to see grains to the downside, dollar to the upside, and metals pull back a little bit, not collapsing, but going back to their support levels.
All right, David, we'll keep a close eye on that. On the bigger picture, we're definitely seeing it play out here on the more intraday. We've got the dollar higher. Traders, that's David Fischer from Landmark Capital. David, always a pleasure to have you on the show.